The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening. It's great to be back again after an extended period away, and I'm looking forward to providing your Monday night dose of property education. This is Your Money, Your Call, and I have two fabulous regular guests here tonight to help me answer all of your questions. But before I introduce them to you, your property news for this week. And experts say that the latest interest rate cut means that property investors win, but first home buyers might just lose. Domain Senior Economist Dr. Andrew Wilson says that Sydney certainly didn't need this stimulus, with median house prices rising by $2,600 a week. But there's no doubt the Reserve Bank had to drop the cash rate to 2.25%, the lowest levels in 60 years, to boost a flagging national economy. Craig James from CommSec says that we must consider total growth, unemployment and housing markets in other parts of the country. He also knows that there's certainly no boom in the Adelaide housing market or in Canberra. Mr. James and other economists do worry that the rate cut could reignite another investor-led boom, particularly if there are more rate cuts on the way. AMP Chief Economist Dr. Shane Oliver said that this would force prices even higher, adding that interest rate cuts are like cockroaches. There will probably be another one. Both experts said that first home buyers were the biggest losers, with Residex saying that the stark reality is that Sydney is no longer an affordable place to buy and own a home if you are a first home buyer. And in other news, the latest REIV quarterly results show Melbourne's median house price hit $669,000, up 5% on the September quarter after price increases in inner, middle and outer suburbs. REIV Chief Executive Officer Enzo Raimondo said inner Melbourne increased by 11.7% for the year, with middle Melbourne up by 13.2% and outer Melbourne at 8.9%. Overall, Melbourne house prices were up 11.7% compared with 2013 in regional Victoria. The December quarter median house price was at new records too, at $344,000, up 5.5% on September. Well, we're all standing by to answer your questions, so get them ready. And to help me do that this evening, I've asked Michael Teys from The Block Strata and Noel Petrohelos from BMT into the studio. And if you have a question for anyone on the panel this evening, don't wait. Call us right now on 1300 30 34 35 or email your question to me right now at property@skynews.com.au. Welcome to the program. It's great to be back, and let's get started. Welcome to you both.
Thanks, Margaret.
Thanks, Margaret.
Michael, thank you for taking care of the chair in my absence.
Very welcome. It was my pleasure.
It's funny, you know, I travelled to a fair amount of the world this time while I was away. Wherever I went, all people wanted to do was talk property.
It's the universal wealth generator.
Yeah, it is, and people really just are very interested in what's happening in the Australian market. I have difficulty convincing people that in fact the Australian market's been quite buoyant, that we haven't really seen that tragic kind of effect that both the UK and the US saw. And people just don't believe how good it is here in Australia. Is it too good?
No, I don't think it's too good. It's all about fundamental population growth, and we're an attractive destination. We have more immigrants than emigrants. We have more births than deaths. And we're living in smaller household formations. So those fundamentals drive our market. Parts of Europe, the UK and the States can't say the same. So there's big differences, but we're a popular country. People want to come here, they want to live here. And we have a lot to offer. So whilst those numbers stack up as they do, people have to live in houses, houses have to be built, and as our lead story shows tonight, some of our cities are getting unaffordable. So renting starts to become the norm rather than property ownership. And I really think we will start to see some shift in those long-term figures that have had owner-occupiers at about 70% of the market. I really think we'll start to see some shift in that.
Well, of course, you know, many overseas countries, Sweden is a good example, renting is quite the norm and home ownership is a lot lower.
That's right.
You know, I know that people are very reluctant to give up that great Australian dream. It's been really the backbone of our society ever since I can remember, ever since my dad was trying to get me into property at 18. And I think people are reluctant, but it could just be a sign of the future.
And I think we'll see more people who want to, or who will choose to rent their place of residence, but will be property owners.
Yes, yes, true.
The fact that you choose to rent where you live doesn't exclude you, and I think that option will appeal to a lot of people.
Absolutely. Noel, of course, you know, just because we here in Sydney sit here and think housing is unaffordable, you from BMT, you guys work with properties all over the country, and that's not the universal truth, is it? Or certainly not the national truth. There's many affordable areas still in Australia.
There's lots of affordable areas, and I think we fall into the trap of looking at the city, and sure, there's a bunch of people that want to live in the city, but it's getting expensive. And first-time buyers, unfortunately, need to change their strategy a little bit. Look at, as Michael said, investing in the first place and seeing that as an opportunity to enter the housing market. Looking at areas that are a little bit further out and travelling a little bit further. And I think we're going to be seeing that that shift in that culture. And it's the great Australian dream to own your home. You know, having the bank support that, of course, but you know, getting into the property market through investing is an opportunity for a first property owner, and then maybe later on moving into that property or building their wealth that way so that they can buy a first home. And
you know, it's interesting because, as you know, I travel around the country with my show Property Success and talk to mayors and go into a lot of regional areas, and the regional areas are painfully aware of what they need to do to make their cities and their towns more livable, and we're seeing them addressing the employment situation. We're seeing them all compete with each other to attract big business and employment opportunities to their areas. We're certainly seeing them address the cultural divide and the need to have some kind of cultural pursuit, social activity, things for the kids and good schooling. We're seeing many of our bigger regional centres really going hard for those people to move there and begin to create a community and a life. And, you know, no longer does living in the regions mean that you live in a country town. It just means that you choose not to live in the city anymore.
Yeah, they can't be complacent. They've got a lot of these regional areas. Have got these beautiful communities, and you're right. They know what it's like to do it hard. So they're very strategic about where they spend their money. And look, there's a few areas that are not so good at it, but you can pick the ones that are. And if you focus on those areas, you know, and you've got a Lord Mayor or a Mayor in the area that's making the right decisions and bringing money into that town is what needs to happen. Yeah,
absolutely. We're seeing it happening everywhere. Well, look, let's go to the email. And Lee has written this week with an interesting question. Now, she asks, my tenants have given notice unexpectedly and it's my first end of lease. My property manager's tone and shortness towards me appears rude and she doesn't want to give me information about the process. This has been developing over time and it's causing me a lot of stress. We only communicate by email or phone as I live outside the city. We've never actually met. I'd like to change my property manager, but I'd like to stay with the agency. Do you have any thoughts on how I should change managers within the agency? I don't want to jeopardise my prospects for finding good tenants next month. Michael, this one is interesting, isn't it?
It is. It is. A couple of things there. Look, I would say that a fish rots from the head. And if there's a bad culture, if there's a bad attitude coming through, it probably means there's a problem with the agency. Property management's always been very interesting. It's the only part of a real estate business that's worth any money, but the principals tend to focus on the sales rather than the property management side. So it's really quite an odd area. I think you really need to realise how much you're worth to that agency. A property management is worth somewhere between $2,500 to $5,000 in capital value. So every time a property management client threatens to leave an agency, that's a big hit to their balance sheet. So don't be afraid to ring the principal. Make sure that the principal's not the problem. But I would ring the principal and ask for someone else. But make yourself known to the principal and don't be the faceless client. Don't be the person who is just going to fall and become a number.
Okay, and what do you have to say on the topic?
Look, I have property managers that I have never met, and I don't have a problem with them. And it was because I was very careful about selecting them. I listen to other people, I listen to advice of people who are invested in a particular area. I always look at testimonials. You don't need to have a face-to-face relationship with your property manager for it to be successful. It sounds like communication's the key here. I would be going straight to the head and talking to the principal and pretty much putting your foot down and demanding another property manager without putting up with this sort of stuff. And just ask a few questions like, how often should they be contacting me? How often will you be reviewing the rent? And just so you can get some of those systematic things out in the open. And if you're talking about it, then these things just flow on and should sort themselves out. I have come across the odd situation where you might get one person in an organisation that is doing something a little bit against the culture of that organisation, but what Michael said has some truths to it as well, that, you know, sometimes you'll find these organisations might be worth leaving.
I agree. I think there's two things at play here. Firstly, if you are having difficulties with a single property manager, then surely her supervisor knows what she's like. And often there's a real cultural thing that's happening within one organisation. And I found with my own property managers that if one of them is like that, often all of them are. Give them the benefit of the doubt to begin with, though, and speak to the principal of the agency first and ask them whether or not it's typical of this person, whether maybe you're just having a personality clash with them, and tell them what's going on. After all, don't forget, you are paying them, and these organisations are valued according to their rent roll. So they need to have these rentals on their rent roll to have any true value to their agency. So I'd start there. Now, if you have no joy from that, if you can't seem to get a change of property manager, I would definitely change, and I wouldn't worry about the fact that you're already with a large agency and you don't think you'll get as good again. There are plenty of big agencies around at the moment who all do a good job, but there's also plenty of small property managers who do just as good a job, and often they do a better job because they are fighting with these big agencies for market share. So don't be afraid to shop around. Make sure, particularly in those contracts, the property management contracts, that you have short termination periods in them. In Queensland you can't have less than a month, but in other states you can nominate any termination period. Keep them short so that if this happens again to you, you can quite quickly and easily change property managers without having to serve out a very long term that might have been in that original contract. Aresh, you're on the line now from Melbourne. How can we help you, Aresh?
Hi, Margaret and the panel. Thank you for taking my call. I'm just looking first to purchase an apartment in either Hughesdale or in Clayton, which is in the southeast of Melbourne, just first as a primary residence, but then later on 4 or 5 years as an investment property to maybe leverage off that and buy something bigger. I was just wondering what your and your panel's view is on both suburbs and what the rental returns are for both areas.
Okay, now let me see if I've got this right. Your plan is to originally move into that area, but then you will keep your former principal place of residence as a rental, but move on to something bigger for yourself as your own home. Is that correct?
That's correct, yes.
Okay. Michael.
All right. Well, Aresh, of course, there is a lot of news around about an oversupply of apartments in Melbourne. And primarily, this is in the inner city, around the city, the CBD, South Bank, Port Melbourne, and down St Kilda Road. Where you are, you're about 20k out. You should be sheltered from that sort of that sort of situation. So, if it's going to be your principal place of residence, of course, then at least for the initial period, you're mainly concerned then with the quality of the finish in the apartments that you're looking for, and you're looking for something that's going to be a good rentable proposition down the track. So first thing to do is to make sure that your particular area is not oversupplied. I'd be talking to some local agents about the vacancy rates there, but assuming that there's no oversupply, and I don't think there is in those sorts of areas, then that's okay. Then you need to move on and ask yourself all the other questions about why are you buying there, is it close to transport, all those essential things to make sure that it is going to be a rentable proposition. As a general proposition, I don't like mixing agenda. I think you should buy where you want to live and you should invest where you want to invest. But if at the back of your mind you have this as a possibility for rental later on, at least you can be thinking generally in those terms.
And Noel, what have you got to say about this?
Look, those areas, in those outer areas, I think have performed quite well in the last 12 months, and I can't see why they wouldn't keep performing. As Michael said, there's been an oversupply of apartments in the city. I've seen properties that, or clients of ours that invested in those areas in the southeast of Melbourne, getting yields of around the 4 to 5%, which is quite healthy. So the recipe looks good there. My only advice would be to Arish is to just get some advice on how he sets up those loans, because if that's going to be a primary place of residence to start off with, and then an investment property later on, he really needs to get that advice with that in mind, so that later on he can have he can manage his debt so that he does have the most amount of debt on the property that's producing income, because that's the debt that's tax deductible.
Yeah, that's excellent advice, and it's where I was going to go as well. In terms of Clayton, Hughesdale, out near Monash, there is a lot of infrastructure going into Monash, as you would know at the moment. The roads have been improved out there. There's a fair amount of building going on. At this stage, limited mostly to residential or, to houses or duplexes. There's quite a lot of duplexes down there as well. Some apartments are now coming through, and as Michael said, just keep an eye on that, because if it was me, I'd be going to the council and finding out what the future plans are. There's a fair amount of land still available around there as well, and my only concern is with their plans for high density, that they might just allow a lot more high density. You know, the universities out there, and we don't want to see you falling into a situation where the property that you buy doesn't grow well because of this oversupply. With new properties coming on the market all the time, then it's difficult to sell an existing property. My bigger concern is with your plan to live in it and then move on, and as Noel says, you've got to be careful with that debt. What a lot of people do is they move in, they work on their debt the way they always would with a normal principal place of residence. They love the place, they move out and keep it to rent it out, and they use its equity to raise a big debt on a new property that they're going to be living in. They then have a really big debt on a property that they're living in. They have a really small debt or a relatively small debt on a property they're renting out where they're getting all the deductions, and it's upside down financially. What I would do, and I think Michael alluded to this, consider your needs as an owner-occupier today. Buy a property for that reason today. When the time comes for you to move out, sell it. It's a capital gains tax-free asset to you, whatever it was your principal place of residence. Take all the money that you've made and all the deposit that you put in and roll it into a new principal place of residence. Create instant equity in your new home, leverage back and buy an investment somewhere that is a good investment proposition. Well, I'm glad that you stayed with us this evening. As you know, every Monday night, the panel and I will choose one question from either the emails or the calls, and we send a copy of one of my books. Now, this week, every single question that is asked and answered on this show tonight will receive my ebook, How to Achieve Success in Property Negotiations. It's a must-have if you're ready to buy, and it will save you thousands on the way in, which is where you make the first amount of money on a property. Call us now on 1300 30 34 35 or email property@skynews.com.au with a question, and then make sure you watch at the end of the show to find out how to claim your book. We're off for a few important messages. Don't go away. When we come back, I'll take some more calls and also answer some more email. I'm so glad that you stayed with us for the show tonight. Now, if you've just tuned in, tonight I'm joined by Michael Teys from the Block Strata and Noel Petrohelos from BMT, and we're here to make sure that you get the answers that you need. If you have a question, grab the phone and call us on 1300 30 34 35, or of course you can email us on property@skynews.com.au. Now remember, each call and email answered on the show here tonight will receive my ebook, How to Achieve Success in Property Negotiations. Now, Susan, you're from Lambton and you're on the line. How are you?
Yes, I'm good, thank you.
What's your question, Susan?
I'm just wanting your feedback and whether you've got any really good knowledge on the area of Port Stephens as well as the perimeters of Newcastle. I've got kids that are trying to get into the Newcastle market, and it's tagging on to Sydney, and some of the prices are just getting ridiculous. So I'm just not sure whether the Port Stephens area may still be a little bit, particularly around the Anna Bay, Nelson Bay area. Now, how do you feel about those areas?
Susan, will they want to move in, or are they looking to invest?
Well, either one, or they do want somewhere to live. So again, first in the Newcastle area, they've missed out on a property in Merriweather Heights, and I don't think realistically that's going to be achievable. Not quite sure where else is in that perimeter where there's a decent area to buy, and it's still got some growth.
Yes.
And obviously Port Stephens not that far away. It's a bit concerning really, which values are sort of run away too fast and where the other ones are still achievable.
Okay, Noel, I believe you're a Newcastle boy. Are you?
Yeah, I went to university
You certainly
there.
spent some time there.
I've spent some time in Newcastle, and look, Port Stephens to start off with, it's had a rough trot for the last probably fairly long time.
It's like it was really oversold though, with developers going in there and doing all of those holidays.
And there was
dreadful.
Amazing marketing concepts behind them, but that's unfortunately back in 2005. That's what they were, and there was some projects there that were overpriced and some properties. So it hasn't done a whole heap. Beautiful holiday destination, but it is starting to. It's still very popular. You've just got to be careful. It's still an hour out of Newcastle where all the action is. Yeah. So that's. It might not seem like a long way, but in that area, there are closer places to live with stronger drivers in other areas.
More affordable though?
Definitely more affordable. Looking at Merriweather Heights is a little bit silly to start off with. It's an expensive suburb. For me, I'd be looking at places like Cardiff, North Lambton, Mayfield, Tara South, those kind of areas that have just been left behind a little bit. And there's other areas like Hamilton that have done really well, but then there's suburbs like Mayfield that are right next door to Hamilton, close to the beach, close to the city, but haven't performed in the same way, and you can still get a good buy in there for somewhere between the $350 and $450, and getting a solid rental yield of $400 a week. Yeah,
and even a little bit cheaper in some of those areas.
Yeah, definitely.
Okay, Michael.
2 points, Margaret. I remember Nelson Bay not that long ago had the highest incidence of mortgage default.
It did. It did. In fact, that's correct.
And that was what, 3 years ago.
Exactly.
So that the effect of that would still be playing out, I would assume. But the second thing I detected in the question was again this uncertainty as to what the purpose of the investment was. To buy or to rent, there wasn't a clear answer from our caller, and I think. It's something I'm teaching at university at the moment, and good luck to my students who have their exam on Wednesday. Hope you all go well. But it's something I've been teaching there, that we really need to be clear about what we're doing with our property and what outcomes are we expecting. Are we expecting income? Are we expecting growth? Do we want lifestyle? Do we want care in the case of retirement villages? And you can't get them all from one piece of property. So really, to be clear, are we buying this as a residence or are we buying this as an investment? Totally different conversation to be had.
I agree, and you can't mix them up. If they're going to invest, then I'd say nowhere in Newcastle. I'd say invest in Brisbane or another area. If they're going to live in it, then all of the areas that Noel has suggested sound just perfect. But it's got to be about why they're investing, because when we buy to live in, it's an entirely different set of parameters than when we're buying to invest in. I did a fairly big analysis of Port Stephens, Anna Bay and Nelson Bay around about 12 months ago, and not only was the historical growth pretty terrible, but there was just no signs that was going to change anytime in the near future. It'll be dragged up a little bit by the growth around it in Newcastle and the spillover from Sydney, but we're not looking at a long-term option because they're essentially holiday areas and retirement areas, and they simply lack the employment and growth drivers you need to get the best out of the investment. Well, this is Your Money, Your Call, and although we're having a great time, we do need to take another break. It won't take long, so stay tuned, and perhaps even call us now on 1300 30 34 35 or email us on property@skynews.com.au. We'll be right back. Welcome back and thanks for watching. I'm Margaret Lomas, and with me tonight is Michael Teys from the Block Strata and Noel Petrohelos from BMT. Now, we've had some really good questions tonight, like we always do, but we have time for some more. So get to your phone now and dial 1300 30 34 35 or email us on property@skynews.com.au. Remember, if we answer your question tonight, you will receive a copy of my ebook, How to Achieve Success in Property Negotiations. Now, before we do go to the phones again, here's some news about a fabulous event which I'm privileged to be hosting and presenting in, which kicks off on the 28th of February in Sydney. I see too many workshops and seminars put on by people who either want to sell property to investors or to sell expensive boot camps and the like, which really provide little education. So I decided to do something about it, and I've asked the top property experts in Australia to join me to give you a high-value, low-cost day of pure education. Now, it starts in Sydney on the 28th of February. I'll be joined by leading property economist Andrew Wilson, finance guru Lisa Montgomery, strata expert Michael Teys, property tax whiz Ian Rodriguez, and depreciation specialist Brad Beer. And you'll get a day like you've never had before. We are your property team, and this one day at a fraction the cost of similar days elsewhere will definitely set you up for many years of successful property investing. Now, we'll only do this once a year, so this is your only chance to get ahead of the game and leap into your property investing nice and early in 2015. And we're also having a special broadcast of Your Money, Your Call in the afternoon with your questions answered live. Get your tickets right now from yourpropertyteam.com.au. That'll probably come up on the screen at some time, if not now, sometime through the evening, yourpropertyteam.com.au. Now, the next question is right up the alley of my two experts this week and comes from Ruby, who asks, Dear Margaret, Michael and the panel, I'm a keen follower of the show and enjoy listening to your conversations each week. My question is a general one regarding blocks of units, 4 to 8, on a single title. Whilst currently having a portfolio of 5 properties across 3 states made up of houses and units, I've been constantly attracted to and intrigued at the prospect of owning a block of units. Good cash flow with the potential to improve valuations through renovations unit by unit or to make improvements across the board. Does the panel have any thoughts or advice when considering this type of acquisition to a portfolio? Michael, first of all, I thought you could address the whole unit question.
Yeah, so Ruby, it sounds like you've got some good diversification in your portfolio. So a strategy of holding more than one unit in a building probably suits you. I'd say for a first-time investor this would be something that you wouldn't do, but as you seem to be an experienced investor, I think you tick that box. Owning all the units in a strata plan enables you to do things that you couldn't do if you only owned 1 or 2, and that's because if you own all of them, you'll control the owner's corporation or body corporate, depending on what state you're in. Each has different language, but you will control that. So you'll be able to develop common property if, for example, the site is underdeveloped, and some of the properties in Queensland, for example, along the beach are underdeveloped. So there's some good opportunities that can come out of controlling it. Of course, when you're even a majority owner and you have maybe one person who owns 1 unit and you own the other 5 or 6, then you're totally constrained in what you can do because you need unanimous buy-in and unanimous votes to do anything of moment. So the opportunity that you've identified is a good one, and you will get flexibility from being the total controller of the owner's corporation. Some things to watch out. When you go to borrow, you'll be treated as a commercial property buyer, so you won't get the pure residential LVR that you would if you were buying just a single unit. So there'll be some impact there on your financing. When you do strata title, when you do lodge the plan to divide the units up so that you can sell them off, at that point you will be taxed more heavily and there will be increased rates from the local government. So there's some things to watch.
Excellent. And from a depreciation point of view, what does Ruby need to know?
Look, they work out quite well. There's a bunch of units in a block. Now, when you own one single unit, you only have a percentage of ownership over the common area, so you can only claim for depreciation your little percentage of the common asset. So if there's a lift or there's a stairwell or there's a driveway or something like that, you get your little percentage. If you own the whole thing, you can, as Michael said, if you do add value or there's existing value in the common area, you can claim that whole thing. But you can also claim all of the stoves, all of the carpets, all of the light fittings right throughout that whole building. They always work out quite well from a depreciation perspective. The only thing I would say negative added to what Michael said is that it is a lot of eggs in one basket with a number of properties. It sounds like Ruby's been quite good at diversifying and spreading her properties around, and now she's probably going to look at it a little bit differently and pour a fair bit of money into one single area that might be reliant on one single economy. And you know, if something goes wrong in that particular area and those drivers in that particular area do change, then all of those units will be affected. But look, a lot of our clients buy those kind of buildings, and you know, with the opportunity to add value and split them up, strata them off, and get the value out of them that way, they often work out quite well.
Yeah, good advice from the panel there, Ruby. And to that, I will add the fact that what the bank will do when they value it is they will value it lower, being that it is not strata titled. So you will lose value on those properties, even though you'll probably pay the same because they aren't strata titled. And in some councils, the cost of strata titling can be surprisingly expensive. And so you will, once you strata title them, you can get the bank back in to revalue them for you. But if it's a block of 4 or more and it's all in one line, they won't consider the individual values as if they were separate. They'll only consider them as one block, and they'll give you an aggregate value throughout the whole lot. Of course, the other problem could be, in some states, they will also aggregate the stamp duty. So while you might pay, otherwise, if you bought 4 units in 4 different states on one day and settled them all on one day, you would pay the stamp duty on the value of each unit. If you buy it all in one block, you'll pay the stamp duty on the whole lot. And the way stamp duty works is the higher the value, the proportionately more the stamp duty is going to be. And so 4 together will be more stamp duty than 4 single properties. So something else for you to consider as well. Helen from Sydney, how are you going, Helen?
Thank you very much for taking my call, Margaret.
You're welcome.
I'm doing really well.
What can I do for you?
We've recently paid off our mortgage for our primary residence, and now we're looking to create a property portfolio. One of the mechanisms that we're looking into is a self-managed super fund. Now, we have actually already created the self-managed super fund, and we've rolled over some money. Now, we would be looking to borrow to help invest in the self-managed super fund. So this is only one mechanism, as we're also looking to buy outside the self-managed super fund. So we're comfortable with the concept of negative gearing outside the self-managed super fund, but not really sure what we should be targeting for buying a property in the self-managed super fund. Should we be looking at high yield? Should we be looking at capital gains and long-term growth, given that we've got 25 years before we can even touch the investment anyway?
Yep.
New units, old houses, any sort of tips that you can sort of guide us in?
Okay. So first of all, I'll make it very clear to the viewers at home and to Helen that we can't give you any advice on self-managed super funds. It's against the law to do that unless we're duly qualified, and it's a particularly tricky area. The second thing I really want to point out, Michael and Noel, is that the government is becoming very concerned with how highly geared self-managed super funds are, and I'm of the opinion that they're going to reverse the rules to be able to borrow in a self-managed super fund, or at least considerably reduce the loan to valuation ratios, probably down to around 50%. Now, in my opinion, already too many people are advised to set up self-managed superannuation funds when they really don't have enough money to do so. I personally think you need at least $500,000 to make it worthwhile. The costs of maintaining a self-managed super fund are very high. If you've got only $100,000 or $150,000, you can be paying 4 and 5% a year just to have it managed, which eats into any return anyway. So aside from all of that, Michael, what would you advise?
Look, I agree with all of that, and particularly in relation to self-managed super funds. I think it's one of the ways that the government will try and put a downward pressure on housing volatility. As the economy is struggling, they've reduced interest rates to do that, but they want to see They won't want to be seeing too much more money go into self-managed super funds. In terms of new apartments, some things to watch out there, because Helen's question was quite general. Almost all apartments in Australia now that are built brand new that are over 3 stories high do not have any form of builder's insurance. So it's really important to understand the quality of the entity that you're dealing with and their track record. They will almost all leak. So you need to have a good strategy for dealing with defects nice and early in the piece, and you need some independent people on your side, not the developer's solicitors, not the developer's strata manager, not the developer's real estate agencies or building managers, but real independent help. The timeframes have been shortened, particularly in New South Wales, by the state government down to less than 2 years. So you really need to be getting onto that very quickly. And owners' corporations take a while to settle down, so you can leave that too late. So really focus on those areas when you're looking at new apartments. They're great in terms of their locality and their facilities, and they'll have excellent tax depreciation benefits that Noel will tell you about, but do be careful about those issues.
Now, just quickly, Noel, in terms of the tax depreciation, my understanding is the self-managed super fund still gets it, but because they only pay tax at 15%, then
that's right.
Very significantly reduced.
It is. So we still do a lot of depreciation schedules for self-managed super funds, but as you said, they're a 15% tax bracket. So if we come up with $10,000, that's $1,500 cash back in the owner's pocket.
Whereas if you've got it in your own name, it could be $450 back. Sorry, $4,500.
$4,500, yeah, because it depends on your marginal tax rate. So every dollar we come up with, depending on how much tax or the rate that you're paying tax, you get that back in your pocket or as a reduced tax liability.
Yep.
And that's where the value comes in depreciation. So I guess I'm always of the opinion to look at any investment, whether it's a house or a unit, or whether the vehicle's going to be a self-managed super fund or owning in your name, as an investment. You know, short, long term, forgetting the fact of the vehicle that holds that investment.
Yeah, look, Helen, I don't know your financial circumstances, so I don't know whether a super fund is right for you or wrong for you, but what I can tell you is that the majority of people I meet who have had a self-managed superannuation fund set up for them shouldn't have had one set up for them in the first place. They're either too far out from retirement in reality. It's not a really effective vessel really for investing in property when you are, particularly if you are an employee who's on a high margin rate of tax, and you need to be getting those tax breaks in your own name. Negative gearing is a far more effective strategy for individuals than it is for super funds. But if you've got a lot of money in that super fund, then everything changes. If you've already set it up, you can use that super fund to invest in other things other than property without gearing it. I think you should get some other opinions, not from the people who set them up and sell them to you, because they make a lot of money out of them in the ongoing management of them. There is a section in my latest book where I do have a complete discussion about the benefits and the drawbacks, and I think you really need to read that before you go any further. Well, time's running out and we need to take one more quick break, but you might still be able to get your question answered if you hurry to the phone, and then you will receive a copy of my new ebook, How to Achieve Success in Property Negotiations. Call us now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Welcome back. It's been a great night with Michael Teys from the Block Strata and Noel Petrohelos from BMT answering your calls. Our lines are now closed, but during the week you can email your questions for next week to property@skynews.com.au, and we just have time for this last caller and this last email. And the caller is Sunny from Sydney. Hi, how are you going, Sunny?
I'm good, Margaret. Thanks for putting a terrific show for all of us. We are really enjoying it.
Excellent.
My question was today around depreciation or potential opportunity to get some value out of your personal place of residence. Like, we have been staying in our own house since last 9 years, and over a period of time we have put an extension. We plan to renovate a kitchen in future. In case if we make this into an investment property, would we get some value back via depreciation?
Okay, sort of.
Yeah, look, I mean, once that property starts to produce income, then he can start to claim that extension that he's put in.
Okay, but he can only claim the decline in value. He can't claim the capital costs of having done it.
No, only the decline in value.
Only the decline in
value. So an asset depreciates whether it's producing income or not. So what will happen is it'll start depreciating from the completion, and it'll keep depreciating, and then it starts to produce income. There'll be a residual amount of value that can be claimed, and that's mainly for the building write-off component. You know, the 2.5% building write-off. There'll be some value left in that. The plant and equipment, because all of the fixtures and fittings, or the carpets, the lights, the blinds, those assets depreciate a lot quicker than the building, so they'll be depreciating quickly based on an effective life while he's living there. There might be some value left in those, but what we usually see if people have lived there for a period of time is the value left in the structural element of the building of that extension. But what we basically can come in and do is allocate a value. If he knows the construction costs, then it's more about splitting that up into, the building component and the assets that depreciate fairly quickly, and basically getting that ratio of assets that depreciate quickly a lot higher, because that's more money back in his pocket. And really does depend on how we set that up, on how long he lives in it as a primary place of residence, and how much value we can create that's left for depreciation purposes.
But unfortunately for Sonny, any money that he's spent on items that are an immediate deduction in the first year, he won't get any of those. So sometimes when you build something or do a renovation, there's a bunch of items that are under the limit, and you can write those off immediately in the first year, but not for him, because the property's not income producing in that first year.
Definitely needs to be income producing to claim the depreciation. So there are a bunch of assets that there'll be nothing left, either because they're less than $300, or they could have been classified as repairs and maintenance.
Yes.
And then he would have claimed that. He's missing out on all of that. It's only the capital improvements and the bigger ticket items.
And whatever their value is in that period of time, and whatever their decline is in that period of time.
Yeah.
Michael, do you have anything to add to that? Probably not.
That's
a depreciation question.
Noel has nailed it.
And the only reason I know so much is because BMT has taught me everything I know about depreciation, which has been great. Well, Louise wants to see her kids get ahead, and so she has this question. And she says, "Hi there. My children, both uni students, have combined savings of around $30,000. They're keen to get into the property market, but without a regular income at this stage, they need some advice as to their best pathway. Could you please advise?" I guess there's a couple of things here, Michael, that would concern me. I'm not sure whether you share those concerns. What would you say to Louise?
Louise, your children might be asking you for assistance. There might be thoughts of you guaranteeing their loan. I think that's something as a parent you might want to do. I understand that, but if you do it, then I think you need to do a few things. You all need to get some separate advice. And even though you're a family and you're tight and you love one another, you do need to get some separate advice. And you do need to have a written agreement. It needn't be a complex agreement, but you do need to have a written agreement about what your obligations are to one another. I've seen too many families fall apart over the years because of a lack of certainty about investing in property together. Brothers, sisters, mums and dads, families together. So have the discussion up front, talk about what you want, do a few what-if scenarios, and there'll never be a better time to work through those issues than right now if you are going to do something to help them. Other than that, you could encourage them to get full-time work and work really hard, and they'll be able to take out their own loan.
Absolutely. That's probably the pathway I'd be using if they were my kids. No.
Look, there's two sides to this kind of thing. There's security and there's serviceability. I think they've got a bit of security there in that $30,000. The serviceability, they're going to struggle a little bit if they're not employed. My advice would be, first steps, go and speak to some kind of finance provider and just have a chat with them, the whole family. And as Michael said, it can get complicated when there's family involved, because as much as they're siblings and they've all lived together, they all have very different long-term plans. I've got 3 kids and they're very different.
Yes.
And that surprised me when the second one was born. How
you thought they'd all just be the same?
They'd all just be the same,
exactly
but
the
they're
same.
so completely
Such
different.
a depreciation consultant, isn't it? Such a depreciation
I thought
consultant.
I was going to be
Quantities.
It didn't fit into the
They all
spreadsheet.
look about the same size. They should be about the same.
Yeah, 3 girls. I thought their personalities, they're very different. And look, this could cause problems long term, as Michael said. But look, I'd be going and speaking to some finance providers and just seeing what the situation is. And their probably advice is going to be what Michael said, to go and get some long-term employment so that you can get that serviceability side of things going.
Michael, I always worry a little bit that, and I often get parents calling me or writing to me because they want want to help the kids out, and very often they're quite prepared to put up their own equity so that the kids can borrow, yet those same parents rarely have good retirement plans of their own in place. And I think the best way you can help your kids is to make sure that you are financially secure in retirement, because if you're not, your kids are going to have to look after you, and that's not a good place to be.
No, it's not.
Look, Louise, I'm just going to add and I guess reiterate what my guests have both said. One of the biggest problems when I see siblings get into investing together is that their plans always change, and pretty soon what happens is one of them wants to do something different, or even if they've agreed on their investing time frame before they go in, someone changes, they'll meet a partner, they'll go overseas, they'll run off to Rio. It's important to know when two people are on a loan together, they are jointly and severally responsible for that loan. So if one of your kids happens to not keep up their side of the bargain, the other one is completely responsible for that whole debt. It also means that if either of them want to go and invest or buy a loan elsewhere, all their equity is tied up with their brother or sister. They can't really access that equity to go on and buy something of their own, and the entire debt is considered theirs, so their capacity to borrow more money to go and do their own thing is reduced. The bank considers that whole debt to be their responsibility, not just half of the debt. But they'll only consider half of the income because they only own half. So it's tricky, and it's fine if you invest with a friend and you end up hating them over it and you can go your separate ways, but you just don't want your kids to end up hating each other because they can't really go their separate ways when they're family. I think let them wait a little bit longer, let them get into some employment, teach them some good savings habits, by all means help them out a little bit, but do so individually when the time comes and when they can support their own loan. And that brings us to the end of this week's show. I'll be back next week, and joining me will be Tony Hayek and Ian Rodriguez, so get those questions sent to me during the week. Thank you to my guests this week, Michael Teys from the Block Strata and Noel Petrohelos from BMT. Now, you'll see both of them again very, very soon. Thanks also to all of our callers and everyone who emailed a question, and to all of the people who had their questions answered on the show tonight. Now, if you could now email me on yourmoneyyourcall@destiny.com.au, and you might see that on your screen in a moment as well. yourmoneyyourcall@destiny.com.au. No, not there, but it's yourmoneyyourcall@destiny.com.au. I'll send you your ebook, How to Achieve Success in Property Negotiations. You can all, and that's not the book that you're being sent. It's a different one, but hey, what the heck? It's a blue one, not a red one, looks the same. You can also follow me on Twitter, Margaret Lomas AU, and if you visit YouTube and go to Channel Destiny, you can watch some really great video. Now make sure you type in Channel Destiny as you see it on the screen with no spaces, and make sure you subscribe when you're there. At the moment, my 20 questions are all being screened. Don't forget, get your tickets to Your Property Team, and that's coming on the screen for sure in a moment. It's yourpropertyteam.com.au. The event's on the 28th of February. You will have a fabulous time, and I'd love to see you there. You can't miss that day. Go to yourpropertyteam.com.au now. Thanks for being with us. I'll see you again next week.